Good afternoon, everyone. My name is James Linder. I'm a certified financial planner with Retirement Strategies, and I'm actually here today on behalf of COPEC. COPEC is Central Ohio Professional Education Council, and it is a nonprofit organization that does free education outreach, similar to programs like this. The website, if you want to check into it, if you have another organization, is COPEC education.org. So I appreciate the opportunity to be out here. Today we're going to talk a little bit about retirement financial planning. And the first thing I'm going to do to kind of make sure we get relaxed a little bit. Who here is stressed out about finances? That's it. These are high-tech stress balls. I want you to squeeze on this during this presentation, okay? All right, take your time. Don't let it get to you. Who else? There you go. Now, I promise you that at the end of this program, you're going to feel much better. There you go. And I'll save a couple for questions. Normally, I spend the time and pass them out with questions, but because it's not easy to walk down here, I'd have to try to hit you from the stage, and I don't think that's appropriate here. So, we are going to spend some time talking about financial planning. Not sure, I think there was a description that was missed. This is really focusing on retirement planning, typically as you're getting within about 10 years of retirement. There's a lot of concepts here that will flow over to everybody, but just be aware of that. And then also, all programs that we do, there's always somebody here that knows a lot and somebody here that doesn't know very much. We're trying to hit that middle group. So if you do know a lot, hopefully you can pick up a few pieces of information. If it goes over your head, just let me know afterwards, and we can break it down in a little bit more detail. Because of limited time, we're going to go ahead and get started right away. Please ask questions as we go. This is your program, not mine. I already know this information. So if we're going into certain areas and it doesn't seem clear or you want me to expand on it in any way, just let me know. We'll go into it. So we'll go ahead and get started here. Basically, one of the major things we really need to focus on, I want to check something real quick, is it's important for everybody to visualize what the retirement is going to look like. How many people here within the last year have thought about retirement more than their next vacation? Awesome. Well, that's good. And many times that's a problem we have. Sometimes too many times people start going forward as they get closer to retirement. They think about it, but have they really thought through what they want it to look like? Well, hopefully through this program today, we're going to give you some exercises and some tools to be able to break that down in a little bit more detail so you can actually visualize what you want it to be. Some of the things we really break down is the concept of needs, wants, and wishes. Has anybody seen politicians when they're on stage during a debate or whatever it might be and they go ahead and say, you know, this is Joe Smith? Or usually it's a female who's 89 years old and they say, this is Mary Jane, she's 89 years old and she's on a fixed income. And she's having to make a decision between paying for her medications or paying for her electricity in her apartment or whatever. Everybody have heard that? What do they mean about fixed income? What are they saying in that particular situation that is relevant that we all need to be focusing on? Anybody have an idea? It never increases, but what's the problem in that situation? Never enough to meet what? Basic needs. That's it. That's our number one goal, is whenever you do the basic retirement plans, we want to focus on, number one, can you meet your basic needs? Then we can play around with, what do you want in retirement? What are some examples of things you may want in retirement? Travel. Obviously, you want to do that before your health starts failing and when you have the time. What else? Eat out more regularly. Get out of the kitchen, right? What is something that typically happens in retirement, maybe sooner than that, but typically happens in retirement that you may not, and it's a good thing, it's a really good thing. What typically happens within your family that you may not think about? Hopefully they're gone by then. Grandkids. Everybody underestimates the power of grandkids. I got my kids through college and I took care of them and all this stuff, but all of a sudden when those grandkids come around, or great-grandkids, all of a sudden you want to do those extra things. You need to budget those in, and sometimes it's more than you think. Those are the wants that we have. What about wishes? Just take it up a notch, right? Instead of taking that trip once every other year to somewhere in the United States, maybe I want to go every year and I want to go to China and I want to, visit the places you never were able to. Those aren't needs. And I would even argue more travel is a want because you don't need to travel. And then the wishes. And you want to solve for each one of those separately in their own expense structure. So we'll get into that a little bit. But the key is take a moment and visualize how you see your retirement. Then implement that into your planning process so you can solve for that. We're going to talk a little bit here. It's a roadmap, and it's a process we go through to make sure that you can develop your own financial plan. Obviously, we're going to go with some basic questions that we need to consider. Obviously, crunching numbers, and we want to make sure we use conservative numbers. Back in the 80s, everybody was estimating we're going to continue to get 12% in the market. How's that working out for you? Right? So those are some things we want to work on. Tax advantage vehicles. You guys here have the thrift savings plan, correct? That's a tax advantaged vehicle for your benefit. Annuities. I'm not here to say they're good, bad, or indifferent, but they are a tool that can be used for retirement. Investment considerations and protection against undue risk. We'll spend very little time on these last three because that's really not the planning, but they're tools that we need to implement. So those are really kind of in an investment program, but we'll touch on those for sure. So, and when you're done and you put this all together, you do have a roadmap. You want to be calculated in your expectation for your retirement needs. So the first thing is, obviously, you need to start sooner than later. What's the biggest reason? And this graph kind of shows a sign of that. What's the biggest difference between starting early versus starting later, which is the yellow line? What's the biggest difference that you can see in the difference of those lines? The return is probably the same. Compounded interest. That's an amazing tool if you use it, but you can't use it over 3 years. It doesn't have the effect. But take a look at this line. It's flat, flat, flat. But as you go on, look how it's starting to turn vertical. You're using pre-tax, tax-deferred money that you're not paying to the IRS to compound on top of itself. Does everybody here understand what compound is? Does anybody want me to go into that? Okay. So compounding growth is a huge deal. It really has an impact. And even if you wait, just because age 65 is the end of this graph, the reality is there's still money you're not using until you're 80. So even if you're not focusing on this till you're 55 or 60, you still have a long time for some of that money to grow compounded. So it's a key to focus on that. And the sooner you start, the more you have a chance of benefiting from that compounded growth effect. Those are just some numbers of the difference. And you see, let's use this one here, a 15-year difference. at the end of this, at age 65, and this is just saving $3,000 annual, you have $254 versus almost $700,000. It's a big difference when you get to those back ends of the compounded growth schedule. Again, what kind of retirement do you want? When do you want to retire? I'm going to give you just a little story about my own father. And by the way, I did ask him permission to use him as an example. We have worked with him from time to time on his plans and what he wanted to do. And we got to a point where he was 63, and he's like, Jay, I think I'm going to retire. I'm like, oh, really? And we hadn't looked at it recently, and so we pulled up his plan, and we went through it, and he wanted to retire. He didn't need to, but he wanted to. And we went through this process, and what it came down to is, what margin of error do you have at your projected mortality? So let's say your projected mortality is age 90. We all want to write our last check to the funeral home, right? And have it bounce, especially, right? I mean, that would be great if we did that, but the reality is we can't predict it that easily. So, if at age 90, he had 2 more years of assets left, that's a very narrow margin of error. What if interest rates aren't as good as we predicted? What if inflation is higher? What if portfolio rate of return? What if healthcare costs go through the roof? What if? What if we end up spending things? I forgot to estimate that I had to replace the roof, and I replaced this or whatever it might be. I forgot, my car's paid off, and I forgot to account for buying new cars 10 years down the road. It's not in my expenses, but I forgot. So you do all these things, and they do happen. So what is your margin of error? So I'm just going to use that as an example. It's not his real situation. But let's say his showed that your assets were going to last to age 92. That's pretty good. But if you work those 2 more years, it pushed it out to age 97. Or something to that effect. Those are 2 more years of high earning, 2 more years of less taking assets from your income from your assets, higher pension maybe. Those last 2 years are your highest 2 years, typically, of earning income. So those 2 years equated to a much larger margin of error in retirement. So we always have to look at that margin of error. I always kind of consider, if we go ahead and say, this isn't a 20-story building, but if I said, hey, I need you to walk around the ledge on a 20-story building, and the ledge is 1 foot wide, that's your margin of error. Now, if I could say it's 10 feet wide, would you do it then? Well, again, not for free, right? But the point is, that's margin of error. That's how realistic this is. I deal with clients all the time who come to me after they retired. What do they no longer have a choice of? Delaying retirement. And so now we have to use the few variables we have. And trust me, I don't want to try to increase your rate of return to make up for it. Because by doing that, I'm increasing your risk of a 2008 happening again and depleting your assets. So we have to be very careful of that. So when you want to retire is real important. And how long will retirement last? Who knows? When Social Security started, there was like 40 people paying for every one. Now it's 3 to every one. Longevity tables, actuarial tables have changed twice since like 1988 or something like that. We are living longer for sure. So that's something we definitely want to focus on. Obviously, genetics, genealogy of your family, your health, your lifestyle, all of those things play a part into what you predict. I joke around sometimes. There's an expiration date on your driver's license, but it's not you. We're not that accurate in our predictions. Again, back to what kind of retirement do you want? Again, we're going to look at the financial independence. A lot of times people confuse the difference between retirement and being financially independent. A lot of times people, they get their 30 years in and, hey, I'm eligible for my pension and I'm going to take it. Or they get a buyout option. I'm going to take it. But if they don't run these numbers, getting that lump sum or whatever it might be looks very attractive. But you have to take into account, are you financially independent to make that many times irrevocable decision. If my father retired at 63, for him, it's an irrevocable decision. He can always get a job somewhere else, but most likely doing what he did, not making the same money he did. So making that move is something you need to be very serious about in your evaluation. Freedom to pursue travel and other hobbies. Live where you want. If you want to have a home in Florida, if you want to move closer to the kids, whatever that might be. And again, provide financially for children and grandchildren. Again, these aren't needs, these are wants and wishes. But financial independence. I just met last week with a client that works over at Grange, and we went through this whole process, and we told her she really wants to leave. She's dealt with cancer. She's 55. She just lost her husband in an accident. A lot of life events that created a lot of stress. She's fortunate there was enough life insurance. We showed her over and over to make sure she feels confident. She is financially independent to do what she wants. She doesn't have to work. And then she said, well, you know what? Things have changed recently. I really enjoy it now. That's fine. You can continue to work. But that's your choice as opposed to being required because you need the money. Financial independence gives you a lot of... What's another example for some people, by being financially independent, gives them the opportunity to do? And let's say they're only 57. Retire early, but let's say that you don't necessarily want to retire. I'm sorry? Well, that's another big issue. Caring for your aging parents. That's obviously something that people need to consider. What I was really kind of thinking about is back to these hobbies. How many people love to golf? And you know what? I've always wanted to work at a golf store. I wanted to give people tips on how to, maybe they're not a golf pro. Maybe they've always wanted to open up their own shop, something that they've always had a passion for but never could do because they're always concerned about the income. By becoming financially independent, maybe you can strive for some of those more enjoyable job career or whatever you might do. Everybody, a lot of times right now with the economy, there's a lot of people going with franchise and doing things. I would never recommend they do that without being financially independent because they could really hurt their finances if it fails because it takes a large investment. Again, the earlier you retire, the shorter the period of time you have to accumulate funds. That's pretty straightforward. And the longer those dollars will need to last. It's really simple. But when we talk about inflation, those are the things that really have an impact on how that looks. Social Security isn't available till age 62. If you're widowed, it's 60. Okay, so any situations like that. There's a couple points about Social Security I want to make. And real quick, Medicare eligibility is age 65. I want to clarify two things. Medicare and Medicaid. A lot of people get those mixed up. Medicare is for your acute health care. And acute health care is when you get better. So let's use an example of a stroke. You have a stroke or a car accident, you're going to receive acute care to get better. At some point, if you're not fully recovered to what you were before, that's when they call it's a plateau. So let's say, for example, you become paralyzed. Well, you're going to use acute care to stabilize your situation, but at some point, you're not going to continue to receive doctor and hospital reimbursement through Medicare or your employer health insurance situation. What then you fall into is long-term care, caring for your maintenance in your state. So that's where Medicaid comes in. So everybody at age 65 gets Medicare for their acute care. Medicaid is only for lower income, so you have to qualify for long-term care. Does that all make sense? That's a whole other program in itself, of course. Social Security, a couple things about Social Security is obviously you can started at 62. Anybody here want to take a guess that if your retirement age is, your normal retirement age by Social Security is 66, how much do you think you lose by taking it at 62? Who said 25? That's a good guess, but 25% is right on the nose. And if your normal retirement age is 67, it's about 30%. And basically, just a quick calculation, it's 0.5% you drop for every month. Then it goes to 5/12 after age 65. So you will decrease that value, and that's for the rest of your life. Now there's two sides of that coin. If you have longevity in your family, you may want to wait purposely so that you have a higher payment for a longer longevity. But if you're not as healthy, if both of your parents passed away at 70, then I would argue get it when you can, right? Because if you don't get it, if you don't take it, it's gone. Two things you want to be concerned about is making sure taxation of Social Security. So there's certain thresholds that you can earn on taxable income that would make it a taxable income situation. So it's tax-free for you, but if you have too much income, it becomes taxable up to 85% of that benefit. And then also, if you are taking that Social Security early and you have too much earned income, so if you're taking Social Security but you're still working, they have an offset, 1 to every $3. So for every $3 you earn, and it's about over $14,000, for every dollar, let me rephrase it, for every $3 you earn, you lose $1 of Social Security. So be aware that there are some penalties. They don't want you to take it early if you're still working or if you're earning too much money. They penalize you for those things. Any questions on that? Okay. Again, how long will it last? Average 65-year-old can expect to live 18.8 years. Back when Social Security started, it was like 3 or 4 years. So we talk about the problem with the Social Security crisis. That's one of the biggest problems about that. The amount of people paying in, but also the longevity. It's two things that are really having a lot of impact on the longevity of those assets. Get into a little personal opinion. Will Social Security be here? I think it absolutely will. The question is, what are the benefits going to be? Right now, they've already started it. They're taxing Social Security. They're offsetting if you take it early. They are delaying the full retirement age for a lot of people. I could see very clearly the coming back at some point and saying, you know what, it's all taxable and your normal retirement age is 70. And that's going to save Social Security. It's just all you can do is decrease the benefits. They're going to do it. It's just a matter of how much. So in general, for people under the age of 50, we don't even use Social Security in our planning, though. Because most people just want, if I get any, great, but I'm not going to rely on it. So it depends on the individual. The average life expectancies to continue to increase most likely, and retirement may last 25 years or more. Anybody here want to take a guess at how many people through the 2010 U.S. Census are 100 years of age or older? Anybody want to take a wild guess? What's that? I don't even know what the percentage is. I'm thinking of numbers, actual numbers. You are close enough that that's good. It's 53,000. Some people say 5 million, some people whatever. 53,000. The reality is 53,000. Think about that. That's a lot of people over the age of 100. So I just see that continuing. I don't see any reason why it wouldn't. I think in general we are less healthy as a society, but we are also dealing with modern science. It's really making it a lot of the things that might have hindered us for our longevity before is definitely helping now and would most likely continue in the future. Am I standing right in front of everybody here? Crunching the numbers. Again, estimate retirement expenses. This, in my opinion, if you break everything down, this is the most important piece that you need to focus on. Back to what I was saying before. What do you want to spend it on? Needs, wants, wishes. There are rules of thumb out there that say, okay, take your income and take 80%, but what if your income's a lot higher than your need? What if it's lower than your need? What if you plan on doing a lot more travel than you did while you're working? I mean, there's all kinds of things that are relevant. You have to do a line item evaluation. What's my rent? What's my mortgage? What's my cable? What's my travel? What's my gifting? Replacement of cars? All those types of things. Be as specific as you can. And, with tools that are out there, they can help bring up ideas that you didn't think of. That's the best way you can do it. Because now you're looking at the actual and you're not just going by which way the wind's blowing. You actually try to really study that. And it's a continual study. Because as things change, you need to adjust your income or you adjust your expenses. Both of those fall in line, but the expenses is the one that is most difficult for most of the people that we deal with to calculate. How many here track their budget? Track their budget. On occasion. And many times it's after the fact when you're like, hey, where'd all my money go? Right? When you're in retirement, you have zero choice. You have to track your budget because you can't go out and work. Well, I mean, you can. But in general, your assets, the income is static. I mean, you can't really control it. You can't control what the market's going to do. If you get a part-time job at Walmart or something, it's not enough to make a big difference. So making sure that you budget, some people, they basically say, when I run out, and I'll deal with the last 5 days if I don't have cash flow. But the reality is if you start dipping into credit cards or start dipping into more income, then you hurt the longevity of your assets. So it's real important to make sure you start, as you get 5 years out, really start keying in on those that income level or the expense level. Estimate retirement income. In general, your income is from fixed. So your Social Security, not your thrift savings plan, that's an asset. Pensions. Those types of estimates, they're pretty accurate, but they give you an idea of what you're dealing with. So make sure you get those projections. And the key is we want to identify the gap. What's the difference? And there's a chart, I'll get to that in a second, talking about the gap. Calculate your retirement investment goal and account for inflation, which we'll talk about as well. Again, expenses, I already talked about that, so I'm going to skip over that. We got a four-legged stool. Sometimes people here might have heard of it as a three-legged stool. There's two thought processes that go into it. In general, we break it up into Social Security and pension. Those are your fixed income. Once you start those, it doesn't change. They may inflate. They may be flat. It just depends. Social Security, obviously, I think this last year was the first time it's gone up in, 3 years? And it used to go up by 3. Now it's going up by 1. After 2 years of not going up at all, you just never know. Then you have and it says 401k, but that's the same as your thrift savings plan, just a different title. And then your other savings and investments that are not tax deferred or tax advantaged. All of those play a part. So what we're looking at is what are your expenses, what are your fixed, then we solve for what your savings need to be to make up that gap. Yes, sir?
Everyone here most likely has a 401k as well as a defined benefit plan. The question I have and I've struggled with is trying to estimate a regular income from the balance of your 401k. So let's say it's $500,000. If you wanted to try to estimate what kind of a monthly income stream you could get from whatever your number is, what would be a reasonable way to go about that?
I don't know if you guys saw a Wall Street Journal report. They're talking about everybody here heard about the 4% rule? The general concept with that is if you start taking 4% from your investments when you retire, typically at 65, then you should be fine. It's such a rule of thumb, I hate it. But the reality is that if you start at 4% and assuming that your investments earn 6, 7% or something like that, as inflation eats into it, you need to start pulling out more, right? So eventually you pull out enough that you start taking out the same amount that it grows, and then eventually you start eating into your principal, and then it depletes. Somebody who's 65 pulling out 4%, by the time they turn 80, it might be 15% or 12%. But as a starting point, 4%. Now again, that's a rule of thumb without actually using the software that goes through all of this. On our software, and any planning software you do, they'll show you year by year what your investments were and what was needed to be taken out of your investments to meet that shortfall, and it shows you that balance all the way down the spreadsheet. So there isn't a straight answer to that other than you have to calculate it and look in your own personal situation or use that 4% rule as a general rule of thumb. So if you have $500,000, you should be able to take out $20,000.
Is that for until your death, basically, or what's the general time frame for doing that?
That's assuming that you're increasing that 4% by 3% every year, if that's your inflation rate. Okay, so that 4% is going to go up because you got to make up for the cost of inflation. So it's going to start at 4, then 4.125, then 4.267. You see what I mean? So it's just a general rule that if you cannot stay below 4% of that 500,000, and remember, is it 500,000 of a 401k, or is it 500,000 of your bank account that's already been taxed? Because if you have 500,000 in your 401k, you don't actually have 500,000, do you? You have whatever is net of taxes. But if you already paid taxes all the way along, then that rule might be, you could change it. You can maybe take out more. So you have to, there's so many variables when you deal with this stuff that it's really hard, but the 4% is a great starting point. You were going to say? Did you have a follow-up? Okay. I hope that helped, but it's not an easy answer. For an individual born in 1957, this is just an example in case you didn't get your Social Security reports. Wait, you guys are on Social Security, right? Yeah. Some are. That's what I want to make sure. But in general, if you earn $70,000, you can expect about $2,000 a month. And again, just get those projections. If it is Social Security, go to socialsecurity.gov and you can run a report, sign in. They don't send statements anymore, so you got to go online to do that or go to the office. And again, we're back to this gap. The biggest thing here we want to look at is I am showing I need $50,000 to live on in this example. And typically we use net of taxes. My estimated annual income in retirement from Social Security and pension is $20,000. Again, it's an arbitrary number. So I have to, through my 401k and savings, make up that difference in that gap. And back to your question, okay, let's use an example. I have a couple who is retired and they both were teachers at high level income, but they lived modestly. They had STRS pensions that was double what their expenses are. So what is their need to take out from investments? Doesn't matter. Versus somebody who is self-employed, who only has Social Security and doesn't have a pension, and they may have a situation like this where they have to rely on their savings to be a lot higher. So they need to save more. But that 4% hopefully should still fall in line. So it is really a personal level as to what that number is and how much you can take. The one thing you need to be careful, and we'll talk about inflation, is if I have $100,000 and I need $5,000 to live on to meet my gap, hey, I'm good, right? 100,000, I earn 5%, I spend 5,000, I'm back to 100,000. How long is that going to work for you? Maybe a couple years. What was the cost of the first car you bought? Yes. $4,000. What can you get for $4,000 today? Not a brand new car, I guarantee you that. Homes, right? What was the cost of your first home? I mean, inflation. People forget the impact of inflation until you think back. Wow, what was the cost of gas? What was the cost of bread? Whatever it is that you want to do, think about those things. That cost of inflation has a huge impact. So that $100,000 earning 5%, and guess what? I have my $5,000 to make up my difference. Next year, I need more than $5,000. But I'm still only going to earn 5% if you assume a level return. So now the next year I need $5,160, whatever it is. So all of a sudden I earn $5,000. So now instead of having $100,000 at the end of the year, what do I have? I have $99,840. So now the next year, 5% is not 5,000, it's 4,000 something, and my need continued to go up. See how those are spreading apart? They eat each other up. And so without taking a good look at how the effect of that inflation with your steady rate of return has on an impact over a long period of time, you'd be shocked as to how quickly that eats it up. For example, you may look at this $50,000 of need, and if you project that out, just do 3% compound for 20 years. I don't know what the number is, but I guarantee it's not 50,000. Maybe 150,000, maybe 100. I don't know what the number is. Yes, sir.
What's your opinion on reverse mortgages as a potential source of income?
Wow, timely question. I really, the concept makes sense. The concept. The key is making sure that you find a reputable organization. And the reason why I say it makes sense, let me give you an example of people ask me questions all the time. Hey, should I pay off my mortgage before I retire? Well, the financial answer to that is no. If you can earn 6% in the market, you got a mortgage at 2%, and you can deduct it and all these things, the financial answer is no. But can you sleep at night? No. Well, then pay it off. You can never use financial numbers to overwhelm what your comfort level tells you. And if you grew up in the Depression era, or your parents were very much in the Depression era mindset of you never use a credit card, those kind of things, you pay things off. You save before you buy. All of those things, which are very prudent. Then in that example, it doesn't make sense to have a mortgage, you pay it off. Reverse mortgages is the same thing. It isn't the most financially feasible option. I have a client, we're talking about this right now. They came to me after they retired. And so we've been doing everything we can to help them stretch their money, watch their budget, invest as much as we can, but protect it as much as we can from the downside. And they're in a situation where they have about $100,000 left. They're taking out $1,300 a month. And again, this is the gap. They need $1,300 a month to meet their need. Not wishes, not wants. $550 of that is to pay their mortgage, a $125,000 house with an $85,000 mortgage. They want to stay in their home. But if they keep spending $1,300 a month, they're going to run out of money by the time they're 80. If they do a reverse, let me rephrase it. If they sell their home and they end up netting $35,000, whatever after expenses, realtor fees and those things, they can rent for about 6 years for that same amount of money. Didn't help much. If they did a reverse mortgage, the way that one was set up is they're not going to get any income from it, but it stops them having to pay that income, and they get to stay in their house for the rest of their lives. Now their $1,300 went down to $800 or $750 or whatever the number is. So in that situation, it may make sense. I'm really careful because I look at the numbers, but it's hard. You need to make sure you find a reputable organization and that the numbers make sense in those situations. I kind of use the example of a school bus. This goes back to annuities. I'm going to comment about that a little bit later. I'm always long-winded, so there are products out there that are missold by unscrupulous people. That doesn't mean the product is bad. It means it's misplaced. School bus. How many people here drove here in a school bus today? Are you telling me school buses aren't useful? But if I was here selling school buses to everybody, you're going to be unhappy, you're going to be unhappy, it's going to be a bad situation. But, oh, you're a school bus driver? You may need a school bus. You have to be very specific as to what the type of program out there and the situation, and make sure it's a perfect match. Too many times people out there are selling school buses as opposed to what is your situation, what is your need, and here's the plan to satisfy it. If anybody approaches you in a product mindset, they don't know you, but they know XYZ company wants me to sell school buses. So make sure you come from the consulting, problem-solving mode, not the product mode. I'm going to jump over that to, this is inflation. Just, again, the reality is that if you have a 6% rate of return with a 2.6% annual inflation, even though your assets may have grown to almost $400,000, its purchasing power is only $183,000. Because again, I can't buy a house for $4,000. I need $150,000 or whatever the equivalent is. So what that dollar's worth is a lot less. Tax-deferred vehicles. The biggest thing I want to just talk about, most people know about these things, but just remember there's two major features of tax-advantaged vehicles. One is, does your savings go in before being taxed? And just to give an example, I work as a landscaper, I make $1,000. I pay 20% in taxes, whatever it is. My net is $800. I take that $800, put it in an investment, and it grows by 5%. Then I have to pay taxes on that growth. There's two things we're talking about there. The deposit, is it pre-tax, and does it grow tax-deferred? So what I would prefer is to take that $1,000, not the $800, and invest it. Then, as it grows, I want it to not be taxed every year. Yes, you're going to have to pay taxes down the road, but remember that first slide we were talking about the compounded benefit? You're receiving compounded benefit on tax money that you didn't have to pay yet. Anybody here see the movie The Firm? Remember when he was down on the Cayman Islands and he's talking to that Sonny Caps, and they're having this discussion, and of course it's not very legal what they were doing and all that stuff, but regardless, he goes, what do you care? It's the best tax-free loan you're ever going to get. That's what this is. The IRS, the government is saying, we're not going to tax you today to incentivize you for retirement. It's the best tax-free loan you're ever going to get. It's still their money. At some point, they're going to tax you, but you got to use it for the time that you were saving it. And that's the reason why they have two rules. The 59.5 rule. Now, there's certain ways around there. There's loopholes. There's hardship, some of those things. But the 59.5 rules, they say, no, we gave you this loophole because it's for your retirement. So if you take it out before 59.5, you'll pay an extra 10% penalty. Now, they've added these exceptions like a first home purchase, college tuition, some other things. And then there's obviously the age 70.5 rule. Okay, that's enough. This was meant for retirement. Now it's time to start taking it out. They're not crazy. They're going to sit there and say you need to start paying taxes on it. So, great programs. If you're not taking advantage of those, you're missing the boat. If you're in a high tax bracket, definitely defer as much as possible. Even if you do this, now again, this is over 30 years, even if you defer and it grows to 57 instead of being taxed at 35, even if you net it out, you are still better off than paying taxes all along the way. The government wants you to do this. Now, the Roth IRA is kind of contradictory of that concept. Hey, pay us the taxes now, we'll give it to you tax-free. And we'll talk about that in a little bit. I'm going to go over Roth and IRA and Roth IRAs real quickly. The contribution limit for last year, this year it's $500 more, but $5,000. If you're over the age of 50, you can do an additional catch-up provision of $1,000. You cannot do an IRA and a Roth. You can if you split it. You know, 3,000 here, 3,000 there, but you can't put 6,000 in each one. So 5,000 with 1,000 catch-up, tax advantage, wide range of investments. One of the things to remember, don't confuse the term IRA, Roth IRA, 401k. Those are IRS terms. They are not investments. Mutual funds, stocks, annuities, those are investments. So if I ask somebody, do you have any IRAs? No, I don't. Well, what do you have? I have a CD. Okay, then I look at the statement and the CD says it's an IRA. An IRA is just a code that they put on your investment to verify that it does not have to be taxed. But it's not an investment. It's an investment tax code. Traditional versus Roth. I get this question a lot. Should I do a Roth or should I do a deductible IRA? The biggest thing here is if you are young, meaning you have a long time, if you're young and you're in a low tax bracket, definitely do a Roth. I can't see any reason why you wouldn't. If you're getting ready to retire, you're going to use the money in a short period, start taking it out, you can get a high deduction by doing the normal, then I would say take the traditional. Other than those two, it's a gray area. Everybody has personal preferences. Is it going to be for inheritance? Is it going to be for my last money in retirement, my first, whatever it might be. But as long as you remember those two things. I also think that as long as you do either one of them, you're 90% of the way there. I mean, who knows what the future holds? Whether it's a coin flip, whether the Roth or the traditional is the best way to go. But if you're younger, in a low tax bracket, definitely look at the Roth options. If you're older in a very high tax bracket, definitely consider the deductions. Distributions, I touched on this a little bit. The age 59, 10% premature. Again, a Roth IRA, similar to a education 529 plan, it's a play on words here, so I want to make sure you understand this. It is not tax-free, it is tax-deferred. A Roth IRA is tax-deferred first. If you take it out properly, then it becomes tax-free. Because if you don't do it properly, it still was tax-deferred, but now you got to pay taxes and penalty on it maybe. So just understand that it's tax-deferred and it has the ability to be tax-free. Is a Roth IRA potentially, one of the things in planning we talk about is making sure you have an emergency fund. Is a Roth IRA potentially, tax-wise, not investment-wise, but tax-wise, a good place to put your emergency fund? No? Anybody here say yes? It can be, and here's the only thing I want to make sure you're aware of. If you put money into a Roth IRA and you're 40 years old, you put $5,000 in, and it grows to $8,000, you're able to take out that $5,000 without paying taxes or a penalty on it. You just can't touch the earnings. If you touch the earnings, then you have penalty, taxes, all of those things. So sometimes those are a good middle ground where, hey, I need the emergency fund, but I could also maybe, if I don't need it, I've already pre-planned a little bit for retirement. So you can play that fence a little bit for your benefit. I'm going to skip over this. I've talked a little bit about this already. Back to your 401k. Do you guys have matches here?
Yes.
Okay. If you have a match, not only do you get pre-tax, then you get tax deferral, then you get, from an individual standpoint, free money. That's the best rate of return you're ever going to get. I don't know what the match rates are, but if you got dollar for dollar up to 3%, that's 100% rate of return on your money. to just participate. So if you have a match, definitely at least consider trying to make sure you're contributing up to that match limit. Sometimes they do dollar for the first 3, then 50 cents on the dollar for the next 2, so you have to put away 5% to get the 4% total match. But make sure you consider those things. Know what those are and take advantage of those. Even if you can't do much higher, at least get that money, because that really helps grow those account balances. For your contributions, $17,000 with a $5,500 catch-up. Again, the reason why these are higher is because their employer-sponsored plans are covered by ERISA, certain laws. They allow you to defer a lot more. If you have a plan like this available to you, you cannot contribute to an IRA and deduct it, but you can still contribute to a Roth IRA. Some 401ks have, let's walk through this. Actually, I want to hit this one point. There is a rule that if you're over the age of 55 and you retire, so let's say I'm 56 years old and I retire, as long as you leave your money in your thrift savings plan or 401k, you can actually take it out before the age of 59 and a half without paying a penalty. But if you roll that over to an IRA, you lose that benefit. This is one of those irrevocable things you need to consider. So if you're over the age of 55, make sure that if you need income from your investments, leave behind enough that can pay whatever income you need between 56 and 59 and a half. Then when you're 59 and a half, you can take as much as you want out of the IRA. There is a provision with the IRA that allows you to take it out as well, but you have to do what's called a 72T systematic distribution. And that's a calculation that says, okay, I'm going to get this set level of money, and I have to either do it for 5 years or age 59 and a half, whichever's longer. So you can do that, but it's very inflexible. Okay? I always do this. I talk a little bit long, and I have to skip through a couple things, so my apologies. 5-year holding requirement for your Roth IRA to make it eligible. Okay? So you can't put money in, earn, then pull it out. They want you to keep it in there for 5 years. That's a big note. Annuities. The biggest thing about annuities, there's 2 major factors that you need to understand. One is, it is a product provided by an insurance company, and because the insurance company provides it, it doesn't need an extra tax code like a 401k or IRA to be tax deferred. It still has to be after-tax contributions. Your life insurance policy is the same way. It can grow tax deferred. So that's one of the reasons if you've already maxed out your 401k and your other savings and you still want to defer your earnings, an annuity might be an option for there. And there's all kinds, there's fixed and variable and those types of things, which we're not going to get into today. The other benefit of an annuity is that you can take an asset and convert it into a guaranteed pension for the rest of your life. So instead of gambling on what the rate of return is going to be on your investments, if you think you have longevity in your future, instead of trying to get a higher rate of return, I'm just going to outlive the mortality tables and beat the insurance company that way. Because the insurance company doesn't know anything about you. They're going off of a table that says the average 65-year-old will pass away at 78, let's say. And there's plenty of people that will pass away at 70, 72, whatever it might be. But if you know for a fact that you have that longevity on your side, you may go ahead and say, you know what, I'm going to go with the annuity payment, because if I live to 90, 95, they paid me more payments than what I put in. Okay? So that's a yield that you get based on mortality, not on rate of return. There's usually an internal rate of return as well. Right now it's not very much because interest rates are so low. But that's something to consider. Investment considerations, the biggest thing I want people to understand about their investments is make sure, please, make sure you study what your risk tolerance is. Make sure you know what your risk tolerance is, and make sure you know what the risk is of your investments, and make a match. Too many times people are investing in investments they're not tied together. Back in the late 90s, how many people here got burnt on the tech bubble? You don't have to raise your hand. And you ended up losing more money than you thought you could because you weren't aware of what the risk of those investments were. That's a perfect example. People were chasing returns, they weren't paying attention, and boom, they ended up losing 60% of their portfolio. It's just being aware of what your risk is, what your risk tolerance is, and matching it up to what the investment is. And obviously a couple things. During your working years, you have to go ahead and consider. I'm not a big advocate to say you have to do this or that or the other, but at least learn about it and consider it. Disability income insurance, that pays you the income you can't get anymore because you can't work. Or life insurance. Again, if I'm not here and I'm the major breadwinner, how's my kids going to go to college? How's my wife going to fund for her retirement or pay off the mortgage? So those are things you want to consider. In retirement, obviously health insurance, your acute care, whether it's Medicare and you get a supplement, or you have a primary and you use Medicare as a secondary, or long-term care insurance. Long-term care insurance is one of the most under-evaluated programs to make sure you preserve the assets that you do have. And develop your own roadmap. Start now. Invest regularly. Purchase appropriate insurance coverage and review the plan regularly. I'm almost right on time. I can stick around for questions. Thank you guys so much for having me here. And I appreciate the opportunity to speak about this important topic with you. Thank you so much. I think there are evaluation forms. Let me know how I do. I'm a financial planner. I do the best that I can. I'm not a professional speaker, but I always could use tips if I'm not speaking loud enough. Down here, whatever it might be, I appreciate it. Also, if you have personal questions that we can't answer in front of other people, I'd be happy to help you with those. Just jot them down in section 4, and I'd be happy to talk to you if you need that help. So thank you so much. Appreciate it.